German government cuts GDP growth forecast to 1% for 2026 and 1.3% for 2027. IMF says Canada could raise real GDP by nearly 7%. And dollar pins near four-year low as Trump comments fuel selling. Good evening and welcome to the Economic Bulletin. We start off with global news as Goldman Sachs has stated that investor risk appetite has reached its highest level in 5 years as economic optimism offsets geopolitical concerns. The bank's risk appetite indicator hit 1.09 last week in the 98th percentile of readings since 1991. The bank noted that such levels are rare but do not necessarily signal a market downturn, with equity returns supported by a strong macro backdrop. Most index components show broad risk-taking, with investors favoring small cap and emerging market stocks reflecting the ongoing equity gains seen since last year. In Europe, Reuters reported that the European Union and Vietnam plan to boost trade and investment in critical minerals, semiconductors, and infrastructure. The EU will also consider transferring non-sensitive defense technology and deepen cooperation on trusted telecommunications networks as Chinese firms expand their role in Vietnam's 5G development. Both sides aim to support sustainable mining and processing of critical minerals, strengthen security cooperation, and reaffirm their commitment to a rule-based international order and a stronger World Trade Organization amid pressures from U.S. tariffs. The German government has lowered its GDP growth forecast for 2026 and 2027, citing rising uncertainty in international trade. Growth in 2026 is now projected at 1%, down from 1.3%, while 2027 is forecast at 1.3%, slightly below the previous 1.4% estimate. The Economy Ministry noted that domestic momentum is supporting the cyclical recovery, while external headwinds are easing. Fiscal measures alone are expected to add around 0.67 percentage points to 2026 growth. German Finance Minister Lars Klingbeil has stated that investments are driving growth in Europe's largest economy, but their implementation must accelerate, citing the government's 2026 economic report. Klingbeil said the focus on investment was right, calling for reforms to boost efficiency, unlock potential, and cut bureaucracy without giving further details.
Und als drittes will ich hier auch betonen, es gibt gesetzlich festgelegt einen europäischen Instrumentenkasten.
President of the Hale Institute for Economic Research, IWH, Rent Group, has stated that Germany must pursue structural reforms and accept company bankruptcies as part of reviving economic growth. Europe's largest economy is seeing the highest level of insolvency-related business closures in 11 years. Europe described this as a normal feature of a competitive market, noting that firms struggling with high energy or labor costs should be allowed to fail. He said that Germany needed a process of predatory competition in which new ideas replace old ones, and criticized the government for lacking the drive to remove bureaucratic hurdles that delay new projects. Still in Europe, local media has reported that German prosecutors raided Deutsche Bank's headquarters investigating alleged money laundering linked to sanctioned Russian billionaire Roman Abramovich. The probe focuses on the bank's suspected failure to promptly report suspicious transactions involving companies connected to Abramovich under EU sanctions since March 2022. A spokesperson for the Frankfurt Public Prosecutor's Office confirmed the investigation involves unknown individuals and bank employees for potential violations of the Money Laundering Act. Britain's Office for National Statistics has stated that it will implement changes next month to how it collects grocery price data, which could slightly reduce reported consumer price inflation. The updated data covering about half of British grocery sales will be included in the official CPI and RPI figures from February onward. ONS noted that if the new scanner data had been used between January 2019 and June 2025, the average CPI would have been 0.03 percentage points lower, with monthly rates changing by at least 0.1 percentage points in most cases. The Central Statistics Office has reported that Irish retail sale volumes fell 0.1% year-on-year in December, marking the first annual decline in 9 months and a dramatic drop from revised annual growth of 2.1% the previous month. Retail sales were 0.4% lower in December than November and 0.8% lower if motor traders are excluded.
I would have a significant concern about a growth in protectionist sentiment.
And in Asia, the Bank of Japan data has shown that the leading indicator of Japan's services sector prices increased 2.6% in December from a year earlier, supporting the central bank's view that labor shortages are pushing companies to pass on higher costs. The Services Producer Price Index, which tracks the price companies charges each other for services, rose following a 2.7% gain in November. Price increases were particularly notable in labor-intensive industries such as hotels and construction. In the same vein, minutes from the Bank of Japan meeting has shown that the board viewed mounting inflationary pressure driven by a weak yen, labor shortages and rising wages as well as raw material costs as key factors to deciding the timing of future interest rate hikes. Minutes also showed some members favored caution, while others warned that inflation was becoming more persistent as companies passed on higher costs. Additionally, one member noted that the yen's decline and rising long-term interest rates partly reflected the BOJ's policy rate being too low relative to inflation. Moving to North America, where the Bank of Canada has held its policy rate at 2.25%, in line with expectations, with Governor Tiff McCallum citing high uncertainty around the timing and direction of future rate changes. The central bank also maintained its forecast for modest growth, projecting 1.1% in 2026 and slightly lowering 2027 growth to 1.5% from last year's 1.6%. Inflation, however, is expected to remain near the 2% target. Governor McCallum noted elevated geopolitical risks, a review of the Canada-US-Mexico agreement as key uncertainties. He added that the potential inflationary pressures from tariffs is likely to be offset by excess supply weighing on prices. The International Monetary Fund has stated that Canada could boost real gross domestic product by nearly 7% by removing regulatory barriers that hinder trade between provinces, potentially adding around 210 billion Canadian dollars to the economy over the long term. It noted that Canada's internal market reflects its federal structure, with provinces controlling many policies that shape commerce. While smaller provinces and northern territories would see the largest gains proportionally, the IMF highlighted that all of Canada would benefit from a more efficient allocation of capital. Oil prices hit their highest since late September on Wednesday after a winter storm disrupted U.S. crude output, while a weak U.S. dollar and continued Kazakh outages lent further support. Brent crude futures had ticked up around 1.4% at $68.49 a barrel. U.S. West Texas Intermediate crude was up $1.04, or around 1.7%, at $63.43. Both grades are headed for their biggest monthly rises in percentage terms since July 2023, with Brent set to rise around 12% and WTI around 10%. Deutsche Bank has forecast that gold could climb to $6,000 an ounce in 2026, citing persistent investment demand as central banks and investors increase allocations to non-dollar and real assets. Deutsche Bank, however, added in alternative scenarios, a $6,900 per ounce price would in fact be more in line with the past 2 years' outperformance. Still on gold, prices climbed above the $5,300 per ounce for the first time on Wednesday, driven by economic uncertainty and a weakening U.S. dollar as investors awaited the Federal Reserve's policy decision amid increasing concerns over its independence. Spot gold was up 1.4% at $5,259.78 an ounce, after touching a record $5,311.31. Prices gained more than 3% in the previous session. U.S. gold futures for February delivery jumped at 3.4% to $5,254.10 an ounce. Elsewhere, spot silver rose 0.3% at $113.31 an ounce, after hitting a record high of $117.69 an ounce on Monday. It has gained nearly 60% so far this year. The dollar has steadied on Wednesday, but was still set for its biggest weekly fall since April after U.S. President Donald Trump brushed off this month's slide, prompting concern from European central bankers over the strength of the euro. The euro topped $1.2 for the first time since 2021, and the pound hit 4.5-year highs, while the yen is set for its strongest monthly performance against the dollar since April. The dollar index, which tracks its performance against 6 other currencies, rose 0.3% to 96.216. It remained near 4-year lows when having lost nearly 2.7% since last Wednesday.
No, I think it's great. I mean, the value of the dollar. Look at the business we're doing. No, dollar's doing great. You know, it's very interesting. If you look at China and Japan, I used to fight like hell with them because they always wanted to devalue their yen. You know that? The yen and the yuan. And they'd always want to devalue it. They devalue. And I said, not fair that you devalue because it's hard to compete when they devalue. But they always fought, no, our dollar's very good.
European Central Bank officials have expressed concern over the euro's rapid appreciation against the dollar, warning it could further slow inflation, which is already expected to undershoot the ECB's 2% target. French Central Bank Chief Francois Villeroy de Gaulle said that the euro's strength and its potential impact on lower inflation would be a key factor in guiding monetary policy in the coming months. He added that the weaker US dollar reflected diminished confidence amid unpredictable US economic policy. For further analysis, we're joined from Amman by the head of market research at Equity Group, Ahmed Azam. Thank you, sir, for joining us here on Qnews. Let's start off, sir, by asking about Trump's comments calling the dollar great, even as it hits the 4-year low and kept falling. What does this tell markets, and which of his comments or policies caused the dollar to drop 96 on the index?
To you, and thank you for having me here. It is actually great for U.S. President Donald Trump. He has always asked for some kind of a weak dollar. He wanted a weaker dollar in his second period, and yeah, economically, a weak dollar can actually be beneficial, especially with the U.S. focusing on trade situations. When he came back in office, there were tariffs so that he can close the trade gap with his allies and countries with which he has economic relationships. And so a weak dollar can actually be a supporter for American exports, and it can actually be some kind of index so that they can close the trade gap with the countries. And definitely a weak US dollar can actually help when it comes to decreasing debt that is enormously high now. And so yeah, a weak dollar for the US president is actually really good. But here we don't know if we will reach an erosion when it comes to dollar buying, and this actually can harm the people of the USA, especially if it keeps depreciating throughout the year. And then the replacement trade, or being independent on the US dollar by the countries that are actually or have economic relationships. And then also there are these protective or trade protection. And so yeah, these countries really and heavily depend on the US dollar, so this could actually harm them, and they will be resorting to gold as their safe haven. The central banks have been buying gold, and the reserves have gotten really high. We have seen that over the 3 years, more than 1,000 tons, and this shows that just getting gold without control can actually cause problems. And so yeah, there are countries that now have resorted to gold because they're afraid of things like the sanctions that happened to Russia, for example, or that maybe the US will turn over like what happened with Iran and Venezuela. And so people are resorting, or countries are resorting to more safe options now. And yeah, as you know, the US policy is just taking control of countries' affairs. And so for the investments, for the investors, this is not so good. But for the US, a weak dollar is actually really great. And so here the question is, as a dollar sale of will it be better or will it actually be for the worse? And as you know, for trade, the US dollar is the most important one and is the one that we use, but it shows that the countries who are friends with the US are now not
Yes.
resorting to gold.
I'm glad you brought up the idea of uncertainty. Now, since taking office in 2025, Trump has made a lot of moves and big moves like the trade wars, big spending plans, as well as the Fed's critique. Do you think this has led to the weakening of the dollar against US growth basics? And do you think, as you've stated there, that it has basically disrupted the global order, economically speaking?
Yeah, let's agree that economic growth in the US is still intact. We've seen in the last quarter it had rose to 4.4%, and so as I said, things are intact and going well for the US. But his policy, the US president's policy, is uncertain. We don't. They haven't agreed upon a tariff. The higher court hasn't actually decided yet, but yeah, we're afraid that the tariffs will actually be really high and really strong. But actually, he thinks that they benefit economic growth. But in my opinion, I think that these tariffs can actually get countries to find some kind of a strong replacement, like China, for example. They may be trying to find a stronger country, and yeah, the Fed independence, of course, impacts the US dollar, and yeah, that they're afraid that there will be some kind of intervention from the US president, and that they will be lowering interest rate or will be doing an interest rate cuts, and so this is a precedent actually in U.S.'s history. There was no U.S. president can actually exclude a Fed president like the U.S. President Donald Trump has done, and so yeah, countries are now afraid with all the uncertainty going on, and so getting the U.S. back and so yeah, the it have been the highest than have been higher than September 2025, and then also interest rate cuts pushes them to record these depreciations. But yeah, as I said, they need yields and revenues for their debt. And so when there is this high demand, the investments actually feel uncertain and nervous when it comes to investing in the US dollar. And yeah, the US has released the tariffs on the EU, and then they actually went back on that decision. And there was a report by Deutsche Bank saying that the EU can actually sell about $10 billion, and so this is some kind of indication that the stock market in the US will be the only survivors, especially with the AI revolution going on. And so yeah, I think that this monetary policy and this uncertainty, being nervous when it comes to the policy and how he will be moving forward, all of these are reasons that pressure the US dollar. And so the question here, will we have some kind of attractive plans in the upcoming days? I don't think that with Trump's US policy this won't be happening. We will just be seeing bad reviews about the US dollar.
Well, if we could talk a bit about the euro. Now it's reached $1.20, its best since 2021, rising up about 13 to 14% this year as a key turning point. Why does this matter so much for traders, and why is the ECB on edge, I suppose, about what's happening and cutting dollar holding worldwide, basically? Why is this an issue for the EU?
Yeah, they are really important when it comes, it's important psychologically to the investors. As I said, these rates that you talked about are psychological assurances, basically. And so here, this is some kind of a division point between the ECB and the US Fed. And we have seen in the European Union that they have reached their goal of a 2% inflation. And so this actually, when they reached that rate that they desired, the ECB, whereas the Fed or the US Fed has done an interest rate cut 3 times over the past year. And so here, this difference and between the EU and the US policy is you know, kind of harming the EU now. And yeah, it's causing uncertainty there, because this actually can be a turning point when it comes to the central bank. They have been trying to defend the inflation, as you know. Local currencies appreciation actually pressures the economy, and so here they are really nervous about higher inflation. And so maybe the next step for the ECB will be increasing interest rates and not decreasing them. And so this actually can pressure inflation in the European Union in the upcoming period.
Well, with the Fed deciding today and Powell speaking on rate cuts, could hints of 2 small cuts push the gold up to $5,400, as well as hurt the dollar's safe haven spot for more?
Yeah, these increases are likely actually having gold become a safe haven now makes it really attractive for the investors. And you know, there are geopolitical tensions, and these tensions can actually escalate in the upcoming period, like Iran and Venezuela and even Cuba, Greenland, definitely. And so these geopolitical tensions actually get the investors to buy more gold. And so for Jerome Powell to defend the economic differences. And so yeah, the indicator here for Jerome Powell is it gives the US Fed some more time. It buys them time basically to wait and see the economic indicators, because as you know, their unemployment rate is 4.4%, and so this depreciation when it comes to markets can actually, or gives the US Fed that they can stand up to the US president and to depend or protect and defend the US Fed. And so this is why I think that John Post can actually be cautious in today's meeting, and it says that interest rate cuts can actually be happening soon if they don't have to do otherwise. And so yeah, maybe gold's price will increase further.
Okay, thank you so much from my man. That was the head of market research at Equity Group, Ahmed Azem. Thank you for your insights and thank you for joining us here. And now back to our news. The global stock markets showed a mixed performance during Wednesday's session, with US and Asian markets showing broad gains, while European indices fell the most. In the US, the S&P 500 increased 0.06%, the Nasdaq gained 0.13%, and the Dow Jones Industrial Average edged up 0.11%. In Asia, Hong Kong's Hang Seng hiked 2.58%, Shanghai's composite was up 0.27%, and Japan's Nikkei 225 ticked up 0.05%. Meanwhile, in Europe, the UK FTSE 100 shrank 0.39%, France's CAC 40 sank 0.86%, and Germany's DAX plunged 0.24%. That brings us to the end of our economic news bulletin, but before we wrap up, here's a quick recap of what we've been covering. German government cuts GDP growth forecast to 1% for 2026 and 1.3% for 2027. IMF says Canada could raise real GDP by nearly 7%. And dollar pins near 4-year low as Trump comments fuel selling. That's it for today's Economic News Roundup. Thank you for joining us, and stay informed and stay ahead. Don't forget to follow Qnews on YouTube, Facebook, X, Instagram and TikTok using the handle @QNewsEGY to stay informed.